and say good afternoon and hello, everybody. Thank you so much for joining us. Thank you to the CFA Society of Colorado for hosting this team from S&P to share our thoughts on the topic of net zero. Net zero is a huge topic for us and our clients, and I imagine for you as well. Or if you're not already engaged in work around net zero, perhaps the topic is coming up more frequently with clients and in your line of work. Uh, Earlier this year, the CFA Institute launched the Climate Risk Valuation and Investing Certificate, which we see as another signal of maturation in how the financial community is tackling this topic, and that there is growing demand for expertise within our industry around net zero. So this afternoon, we are looking to just share a bit of information on the topic from a high level, and then dive into details of two particular aspects. First, we're going to look more closely at climate-themed indices, which have an important role to play in aligning portfolios to net zero. And we'll follow that with a more granular look at company level activity around net zero and how this information can be effective in supporting active management, company engagement, and other areas. In addition, my colleague Caleb will provide insights on the CFA's Climate Risk Valuation and Investing Certificate and how that curriculum overlaps with some of our discussion points today. So we really hope you find this information useful. We really encourage you to engage with us on the chat during the presentation as questions come up. We are reserving time at the end of the hour, or the presentation rather, to engage with questions if you want to come off mute or turn your camera on, so we can really engage in a discussion. So with that, I will just do some brief introductions of who you have on the call today. I'm Anna West. I'm a sustainability solutions specialist with S&P Global Sustainable One, joining you from outside of Denver today. And I'm pleased to be joined by my colleagues Maria Sanchez. She's a director of Sustainability Index Product Management at S&P Dow Jones Indices, and she joins us from Mexico City. And then Caleb Boyle, an ESG Client Engagement Associate, and he is also based in Denver with Sustainable One. So on the next slide, I'll just provide a brief intro to Sustainable One, the division or the group rather that Caleb and I sit in. Sustainable One was launched 3 years ago to serve as a center for climate excellence and a company-wide resource for our clients as well as our colleagues. We are not a distinct business division at S&P, which is really indicative that sustainability is not unique to one division. Rather, Sustainable One is a team of more than 800 researchers, analysts, climate scientists, data scientists, and relationship managers that work with our clients across their business needs, whether that touches on the ratings division, market intelligence, or S&P Dow Jones indices. So each of these divisions supports workflows across the pillars of sustainability and impact, regulation and reporting, and the topic of our discussion today, which is environmental and climate workflows. On the next slide, we are just going to start out with a level setting on the definition of net zero, just to make sure we're all starting from the same point and to get a sense of global corporate action around the topic. So net zero came about following the 2015 Paris Climate Accord, where governments committed to a goal of limiting global temperature rise to 1.5 degrees Celsius above pre-industrial levels. And then the Intergovernmental Panel on Climate Change, also known as the IPCC, stated in 2018 that the world needs to reach net zero by around 2050 if we are to meet the Paris Agreement target of limiting global warming. So we're nearly a decade after that historic climate accord, and we're seeing companies increasingly adopt net zero targets in order to align their activities with this goal, the urgency of which is becoming more apparent each year. Failing to achieve net zero will increase the exposure to climate transition and physical risks for both individuals, corporations, and really economies at large. So due to the lack of common understanding around what is net zero, the Science Based Targets Initiative, or SBTI, another acronym, has developed a global science-based standard for companies to set net zero targets. This shows the progress they've made. We see over 4,000 companies and financial institutions have science-based targets that are validated by the SBTI at the end of 2023, and that's more than double in 2022. So half of the companies that have set science-based targets did so for the first time last year. And then when you look at financial institutions, the number of financial institutions with science-based targets increased 83% from 2022 to 2023. So we are seeing enormous growth in action from across areas of the economy. On the next slide, I've listed just a few of the asset owners and frameworks that support the implementation of this goal. This is absolutely not an exhaustive list, just rather meant to communicate the maturity we're seeing in the sector and the continuous refinement of methodologies that that are being applied. I mentioned the SBTI on the previous slide. Right now, they're undergoing revisions and updates to their corporate net zero standard. And really in this past decade, or if it's even 10 years, we're beginning to see more standardization in the approach to managing net zero portfolio goals. And that includes a big push in demand for more data to be able to measure progress. So I don't mean to paint a very global, rosy global picture rather around net zero. In fact, it's very mixed in terms of country and region specific regulations, the application of policy levers, and even a re-examination from some investment managers for participation in some of these third-party initiatives. We've recently seen departures from Climate Action 100, for example. But overall, we're seeing very positive problem solving that's happening in the financial sector around net zero. And so on the next slide, I'll just dive into a little bit more of what does that problem solving look like at the investment and portfolio levels. So typically we see clients that start with measurement. You have to know what you own, and then investors can set targets to commit to a reduction in portfolio level GHG emissions. And then it becomes part of a process. We're going to repeat the financed emissions benchmarking exercise regularly to monitor that progress over time. Then we get into the nitty gritty of implementation. You're going to look at your holdings to see what is in line with a net zero target and what is not. And as I put up this bar chart that shows certain sectors are likely to be hot spots in the portfolio. Energy, industrials, utilities, of course, these are at the top of our carbon intensive list. And so it really depends on where those exposures sit within the portfolio, which can be more or less challenging for targeting them for net zero. So public equities tend to have the most data available, along with public fixed income. But we are seeing more granular strategies targeting privately held asset classes as well for both measurement and implementation. That's these sectors in the private arena can be very carbon intensive, but also really wonderful opportunities for net zero alignment. So getting down deeper into portfolio implementation, the levers that investors can pull to take action range. There's simple divestment. You can tilt your portfolios within or across sectors, right on down to revisiting or resetting portfolio allocation targets overall. So that's just a quick introduction, but I think it's a great time to transition to my colleague Maria. She's going to discuss some of the passive options for aligning net zero portfolios. Over to you, Maria.
Thank you. Thank you very much, Anna, and thank you all for joining. So I'm part of S&P Dow Jones Indices, that it's a division of S&P Global, and we are an independent global index provider. What we do is to provide transparency to the financial markets through our indices, data, and analysis that we offer. Now, as new investment themes emerge, the need of suitable indices also grows. Why is it important to provide climate indices? So climate change is a fundamental long-term risk. Investors need solutions for incorporating climate data in their portfolios, and investors can influence positive outcomes. So investments in low carbon and climate resilient strategies have been driven in the recent years by the net zero commitments that Anna was mentioning of asset owners and their sponsoring companies. As of February of this year, the global ETF asset under management of the Paris Aligned Index series that we have, it reached $2.6 billion. In the next slide, please. So we have a philosophy as independent index provider to offer choice to the market. So what we do is offer a wide range of climate-focused indices that enable our clients to measure the performance of companies in relation to the climate risk and opportunities. That said, it's clearly an evolution that we have seen in this space. Early in the beginning, we saw some climate investment clients moving to the vesture. And while there's still some institutions who are going through this route, there's much more varied approach to climate investment now. Certainly, in North America, we have seen a demand for climate opportunities, and that has resulted on benchmarks such as the S&P Global Clean Energy Index. We also offer broader alternatives for low carbon journey that goes from decarbonization compared with the parent point in time to decarbonization trajectories, and that has a goal to become net zero by the 2050. On the next slide, we have, I'm presenting here what we want to start, that it's the carbon efficient index. So the carbon efficient index methodology has gained a lot of attraction and interest in North America because it's rules based and it's targeting also sector neutrality, including energy sector. And it tries to reward the corporate behavior. In the past, we worked with GPIF in Japan, and they felt strongly about changing corporate behavior rather than just reducing exposures to the high emitters in high emitting sectors. Two important differences versus other climate indices that we have is that first, it's rules based, and second, it's using scope 1 and scope 2. As you know, there's scope 1 and 2, but also scope 3. That scope 3 incorporates the activity um, through the value chain of a company. All the metrics that I will be referring here are trying to achieve index level objective, no? Like the reduction, it's in the index level uh, for this rules-based strategy and for other strategies that I will be detailing here. So when we were designing this index, we have in mind that we wanted to reduce the carbon intensity of the portfolio, maintain possible as similar as possible characteristics of the underlying index, and also maintain sector neutrality. On the next slide, please. So here it's just a 3 steps process that it's actually the methodology. We start by defining the global standards, that it's a unique classification system developed specifically for these indices, and it's used to define the weighting adjustments for a given constituent. Second, we identify the high impact industry groups and companies with insufficient disclosure of carbon emissions. And the third point is just the constituent weight adjustments. So we start with members in the underlying index that and apply screens. No, so the first one is companies that do not disclose carbon figures and are higher emitters, they are excluded. What's a high emitter? A stock is considered a high emitter if its emissions are in the 100 highest emitters within the S&P Global Large Mid Cap. Second, we apply some liquidity criteria when needed, and we account for controversies. So we screen out companies defined as at risk by using rep risk indicator with a threshold of 75. In the next slide, it's once we have the legible universe, all stocks are selected and form the index. But what we do then is overweight or underweight those companies that have lower or higher levels of greenhouse gas emissions per unit of revenue within each industry group so that we can reflect its company's relative carbon to revenue footprint within the industry group, and also taking in consideration if they are integrating TCFD framework considerations. So in this way, we have a rules-based index which reduces carbon intensity in the portfolio level, but also maintains similar characteristics of the underlying index. In the next slide, This is another strategy. So this is one of our most ambitious set of indices, and we launched them back in 2020. In March of 2018, the European Commission published its action plan to reorient capital flows towards investments for sustainable and inclusive growth. The key of this is having greater private sector environmental spending. To this end, the European Union introduced minimum standards for two climate benchmarks. Those align our investments with the 1.5 degree scenario's trajectory. The climate transition benchmark and a more ambitious one that it's a Paris-aligned benchmark. Both of them are compatible with this scenario. No, so to ensure that the labels are reliable and easy to recognize, only administrators who meet regulatory requirements can use these indices when marketing climate benchmarks in the European Union. What are the minimum standards? First, a carbon intensity reduction with respect to the underlying index, for example, the S&P 500. For climate transition, a 30% decarbonization is required, and for Paris aligned, a 50% decarbonization is required. That was one. The second standard, decarbonization in absolute terms in a rate of 7% annually. So we have a glide path year over year where you try to decarbonize your index or your portfolio 7% annually. And this rate is based on information of the IPCC of 2018. Um, Now, both set of indices have also some exclusions for those involved in ESG controversies or problematic activities, such as controversial weapons, tobacco, and also accounting for social norms, considerations including United Nations Global Compact. Both set of indices, and this is part of this framework of the regulatory requirement, they are designed to maintain the same exposure of high climate impact sectors as they are benchmark indices, no? Meaning that the decarbonization cannot be achieved by simply tilting towards the weights of low climate impact sectors, no? So it's kind of neutrality. However, you will see that Paris aligned has a stricter reduction carbon intensity, but also has some additional exclusions for fossil fuels. So it cannot be really sector neutral, Paris aligned. In our initial approach to CTB, climate transition, and PAB, Paris aligned, S&P Dow Jones indices wanted to go beyond the minimum requirements. In the next slide, it's our definition of what it's going beyond. So being holistic. We wanted also to align ourselves with the recommendations of the TCFD. It means split climate risk and opportunities into transition risk, physical risk, and opportunities. In the transition risk side, transition risk is, for example, the risk associated to a rise on carbon prices or a reputational risk when some consumer demands change, like veganism goods or things like that. And we are incorporating transition risk with including a data set from TrueCost that it's the transition pathway model, that it's a forward-looking model. We are also targeting this via the 7% decarbonization year over year, and trying also to have increased exposure to science-based targets, companies that have these targets incorporated into their decision process. And the physical risk side, physical risk can be accurate risk that are events driven, like, for example, wildfires in Australia or in the US, or chronic risk, like they are gradual, it's like sea level rise. And we incorporate this in the methodology by targeting a reduction in the index level physical risk exposure and capping stock weights based on their physical risk scores. So again, from a sustainable one, we have these magnificent data sets that are able to, that enable us to identify physical risk into our portfolios. And in the opportunities, we are incorporating this in the methodology using a constraint trying to increase the green to brown revenue share. And additionally, we incorporate ESG scores. And initially, we had just the environmental dimension, but then we thought that it was important to incorporate the three dimensions, allowing companies' policies to be evaluated. Companies with stronger policies are likely to be better aligned in a better place to transition to a low carbon economy. In the next slide, please. So, as, as you could notice, we have several ambitious objectives. To achieve them simultaneously, we need an optimization process. We don't use any kind of the common risk-based optimization process. We use what we call the glass box optimization, that it's a numerical solution to minimize the balance of the active stock, sector, and country positions subject to a number of constraints. Those constraints are the ones that are related to the objectives that I just described. The result of this approach is a more transparent weight allocation driven by climate constraints. But what will happen if we are not able to achieve all these goals at once? No, and this is important. We have a constraint relaxation hierarchy. So the optimizer starts relaxing the constraints with the exception of the hard constraints. The hard constraints are the ones that are related to the minimum standards. Now, in the next slide, in this category of the 1.5 degree scenario aligned for net zero by 2050, we have climate transition indices, Paris aligned indices that we just described with this holistic approach. Now, what we have seen is also demand for less sophisticated versions of these Paris aligned and climate transition benchmarks, trying to achieve just minimum standards. We also have carbon budget, which fall in this 1.5 degree scenario line. It's also an optimization index, but here the decarbonization pathway is based in the 2021 IPCC report. This approach, it's not regulated, it's not a regulated European benchmark, so it cannot be named or marketed as Paris aligned or climate transition. And the decarbonization pathway, it's aiming to use the most recent information reports of the IPCC. So it was built to work via vintages. And there where the full fund start decarbonizing at the same pace based on the latest information. It means that it's built for static funds, not necessarily the ones with inflows. No? Depending on the entrance of the vintages, we are expected to decarbonize in a more pronounced rate. No? And this table is summarizing the differences between these three optimized indices. In the next slide, and this is the last one I have, are some results. As you can see, we can have very comparable return figures. These figures are as of April 2024 on different periods. And we have, for example, just the carbon efficient falling a little behind. Regarding the number of constituents, you can see that there's more concentration or less number of constituents as you move towards more strict scenarios. More strict scenarios are higher level of conviction scenarios. No, carbon footprint, in this case, we're disclosing scope 1 and scope 2. For instance, climate transition, Paris aligned, and carbon budget indices are using scope 1, 2, and 3. But here we are just disclosing scope 1, 2. And as you can see, the higher level of conviction, the higher reductions they have, been the highest reduction based on the Paris aligned. And the idea is to increase that reduction over the time with this pace of 7% year over year. But that comes also with higher tracking error. No? Just to finalize this section, I would like to reiterate climate change is a fundamental long-term risk. One can achieve climate goals without necessarily sacrificing performance or broad exposure. And with this, I will let the floor to my colleague Caleb. Thank you.
Thanks, Maria. So diving into the idea of climate transition planning for both corporate and financial market participants is very broad. There's so many different aspects that can be involved in creating corporate transition plans. And the CFA Institute mentions understanding climate scenarios is really the gateway to corporate transition planning. And feedback loops do exist in the sense that if emission targets are not achieved, updated climate scenarios will need to account for more resources to achieve that net zero goal in a reduced amount of time. And each time these goals or emission reduction targets are missed, greater levels of activities to mitigate and adapt will be required. For this reason, it's really important for transition plans to be grounded in other areas that are not just related to targets or emissions, but key areas such as just transition, climate governance, decarbonization strategies, climate policy engagement, supply chains, climate risks, TCFD, and that's just naming a few. This is kind of a holistic idea of how we need to begin thinking about transition plans and whatnot. But before getting into the content, I quickly wanted to address where some of this data and insights are coming from and how you might be able to create similar insights or evaluate transition plans using data across the S&P Global Suite, but specifically the ESG raw data, which we're drawing on today. So what underpins this ESG raw data or the granular company level information that is used to create and help inform some of the indices Maria mentioned earlier, or capture sustainability performance, is underpinned by the corporate sustainability assessment, or as I'll refer to it today, the CSA. And the CSA is an annual assessment that looks to ESG factors expected to have a material impact on not only company growth, profitability, capital efficiency, and risk exposure. Essentially, there are 62 different assessments that have a mix of cross-industry and industry-specific questions in the survey, where we ask to the different companies to fill out this information, using a double materiality framework to help identify and inform the questions, but not only that, the weights of the questions for each specific industry. And this is important in the sense of understanding how an industry might be transitioning or decarbonizing, since each industry is going to have specific nuances to their plans, goals, activities they're engaged on, etc. Here you can kind of begin to see some of the topics that are covered in the CSA. However, this is looking at a very high level. If we take something like the example of climate strategy, which we'll be talking a lot about today, there are many questions in here that ask about different aspects such as climate governance, the TCFD disclosures, climate risk management, climate-related management incentives, physical risk climate adaptation, internal carbon pricing, emission reduction targets, net zero commitments, and a couple others are involved in there as well. But you can start to see the granularity that the raw data really gets down to underpinning the corporate sustainability assessment across the board, across E, S, and G. This granularity or the level of granularity allows us to look at example transition indicators outlined in the CFA Institute through Climate Action 100 Plus framework on the left side, where you can see the relevant areas on the right side correlated to the questions asked in the CSA, which can help further inform on company practices around these key areas. I think it's also important while we're here to briefly touch on a credible transition plan. And according to the OEDC, a credible transition plan will consider really how the company's transition is expected to impact not only workers, but suppliers, local communities, and consumers. And the International Labor Organization, or ILO, as you may have heard before, refers to this as just transition. This brings us back to the idea of a transition plan needing to be more than just an emission reductions framework. It needs to be a multifaceted approach that looks across the business to really future-proof an organization. And here we can see some of the details been published by some of our ratings colleagues, which unfortunately aren't here on the call today, but really talk about the economic impact of a slow transition scenario. And looking across the economy, we can see an annual GDP at risk under different scenarios, including a limited mitigation, which if you're familiar with different climate scenarios, that'd be like an SSP 8.5, or the slow transition, which would be something along the lines of like an SSP 7.0 scenario, and also the Paris Agreement. Additionally, we can also see the adverse physical effects of climate change and the impact of water stress and extreme heat that's responsible for nearly 60% of potential economic losses. The exposure to low-income countries that would result in a slow transition scenario. And you can also start to see the macro impact that transition scenarios have and the importance of companies developing and integrating sound transition plans. And if we look at the current state of really the kind of emission reduction targets and the actual emission trends, we can see there's a large divergence at this current state. There's still a lot of work to be done across many sectors to meet these company emission reduction targets. And you can find some of this information along with a lot of the other macro level data, kind of high level data on the transition tracker that S&P Global has published to the public in the public space. And we can send along links as well, so you guys can kind of view that and see different areas and see some different insights that you could derive from this. But most notable, I think, in the charts, and as you might see, is the energy sector having the least difference in their emissions trend and their targeted emission reduction, which I think is an interesting thing to point out. Well, the previous slide is looking at really the targets and the actual emission performance. It's also important to start investigating other areas that play a role in meeting the goals of the Paris Agreement related to, specifically in this instance, lobbying activities. So as more and more companies commit to supporting the Paris Agreement, whether it be with the net zero targets and climate strategies, there's an increasing scrutiny from both investors and the public on the extent at which these public commitments that companies are putting out in the space are reinforced and not necessarily contradicted by the behavior of companies in their lobbying activities. Companies really have a responsibility to ensure their memberships and really that they don't ensure their lobbying memberships and don't necessarily contradict their climate strategies and to take action when they do. Aligning lobbying activities and trade association memberships with the Paris Agreement help protects the reputation of companies, but also ensures action on climate change is consistent and strong. We can see evidence that the majority of the industries don't have lobbying activities aligned with the Paris Agreement. But when we take a deeper dive into the industrial sector, as you can see on the right, we can start to see that lobbying activities are a lot more aligned when there's net zero commitments in the space, for an example like this. So while lobbying is a key aspect, it is also necessary to look at other areas of the company operations, such as their engagement in their value chain with suppliers. Developing and deploying sound supplier ESG programs is a foundational strategic and operational activity for organizations. This helps understand whether companies have systems or procedures in place to effectively implement the activities of their supplier ESG programs and to identify and address material risks and impacts resulting from supplier activities. So we can start to see here some of the sectors and the percentage of those who have measures to ensure that effective implementation of supplier ESG programs and see some of the highest performing sectors, including communication services, IT, and the utility space. While there are a lot of climate risks that need to be managed by organizations, whether that be physical risk, looking at acute or chronic physical risks, there are also many transition risks that need to be further understood and accounted for. With the rapidly changing nature of regulation, I think it's important to understand both the current and the emerging regulation of how companies are managing and reporting on this risk. But also more specifically with that, we're not going to mention current and emerging regulation, really referring to the current emerging laws with regulation based to aspects like carbon pricing, emissions reporting, existing products and services, and more. It's also interesting to look at reputational risks in the sense that it can help you understand how changing customers or community perception can potentially impact organizations' transition to a lower carbon economy. And when looking across industries, we really can start to see the different strengths and weaknesses of various sectors when it comes to various transitional indicators. When looking here, we can see that the utility space is one of the best performers in terms of reputational risks of both kind of current and emerging regulation as well. And this could be a factor of many different things, whether that be the impending CBAM regulation or other factors as well. I think that's an important thing that we can kind of look at and potentially start to tease out certain key themes. Then transition plans should be transformative, right? They need to cover many years and really they're impacting the entire organization. But it should also intersect with various internal divisions, geographical regions, external parties, such as suppliers, customers, local communities. Because of this, a credible transition plan must be overseen by the company's highest governing body, with senior management aligned throughout the business. Indicators of this can be seen through climate governance, which we're looking at now, where we're really capturing if there's any board oversight and or management level responsibility of these climate issues. The CFA Climate Risk Evaluation and Investing Curriculum cites that with senior management buy-in, any deviation from the progress towards climate targets is more likely to be properly monitored and internally followed by meaningful escalation and rectification measures. Furthermore, the curriculum also articulates that the importance of the tone of leadership is really key, and as the board is ultimately responsible for the long-term success of the company. So using the S&P 500 kind of as a benchmark to begin looking at this and kind of show what that looks like in a more narrow approach rather than looking at broad scale, we wanted to show that a lot of the majority of companies are actually covered when they're looking at the board level oversight and management of their responsibility to climate issues. With kind of surprisingly and interestingly, the materials sector having over 100% of the companies with board or management responsibility, these climate issues, which is an exciting thing to see that kind of progression along. But overall, at a high level, I mean, there's so many different factors that need to be incorporated when thinking about these climate transition plans, whether that be kind of TCFD style aspects, looking at climate engagement policy around climate lobbying, decarbonization, climate governance, such as here, the climate risk management sections, just transition, just to name a few. But there's so many industry specific, but also more broad scale things that we can look at to start understanding and be more clear on articulating how we are kind of looking at transition plans and assessing these. But I'd like to pass it back over to Anna for recapping and kind of doing some of the key takeaways and also leave time for questions.
Thank you so much, Caleb. It is that Maria as well. We really appreciate your expertise here. That's a lot of information in a short period of time, and so I do have a key takeaway slide, but it's not going to necessarily wrap everything up. I think my key takeaways: net zero ambitions apply at multiple levels. We've got government and policy, but companies and investors certainly have their role to play. There is no single approach to how investors are adopting or implementing net zero. But we have standards, we have frameworks to guide investor activity, and there is a great degree of specialization that goes into this field as well. Investors have options for portfolio implementation, active, passive, different parts of your portfolio, and specifically across the climate aligned indices. Very different methodologies and how those are created, but in various ways that can support real world decarbonization efforts. And then lastly, there are many signals out there for investors to ascertain company readiness around the transition to net zero. Whether you want to start with the existence of a public net zero commitment, but then as Caleb was highlighting, drill on down the line to risk and governance practices, supply chain management, and really the details of operations. So those were our prepared remarks for today. We did want to leave time for questions. If you want to jump off mute, we'd love to engage with you if anything has struck your fancy from our prepared remarks. And I will also add we will be following up with our slides as well as additional resources we have. I am going to share my email address. Welcome any outreach or inquiries that I might be able to support with.
I have a question in this in the chat. So the question is: has S&P had a chance to examine ESMA fund naming rules and its impact on PAB and CTV benchmarks? So I don't think PAB CTV benchmarks could be affect. However, yes, we are reviewing the so the ESMA guidelines are for asset managers, are for the funds. However, we have empathy for our clients, and we are reviewing what we can do from our side. Yeah, we can follow up that offline as well.
Yeah, thank you for the question. And I have one for you, Caleb, just because I've taken some CFA certificates in the past, and I'd be curious for this one. Is it something that you can apply to your day job, like right now in real time, or is it more conceptual? I'd just be curious how rigorous you feel like this is and how it overlaps with your current work in this space.
Yeah, no, great question. And yeah, it's it definitely overlaps with a lot of different factors, and it's a very broad course in terms of covering anything from carbon markets to transition finance and a lot of other aspects. So not only does it kind of help in the day-to-day and understanding new or emerging trends, or maybe even areas that necessarily not directly routed in. But also helping kind of understand the broader picture of the entire landscape of ES&G across asset classes, across regulation, and more. But yeah, definitely highly recommend.
Thank you. And I have one other question for Maria that, again, if you have questions, please do feel free to jump in. Otherwise, we'll wrap up a little bit early. But Maria, from your standpoint, I'd just be curious of the indices that you presented on today. Um, can you give us any color on investor demand, whether that's by assets or what region you're seeing the most interest from?
Yes, absolutely. So for the carbon efficient, we have seen a lot of interest because it's rules based and not even when it's not necessarily following European regulated indices. And we have this big fund, pension fund in Japan, GPIF. So they started with this, and they are taking this not just for guiding their investments, but also for engaging with companies. No, that's why for them, what's very important to identify at the beginning was just disclosures, and the methodology is just to send a note. Methodologies are live documents, and they are capturing the new trends and the new requests from our clients. That's when we recently incorporated TCFD alignment in the carbon efficient indices as well. And the other demand that we have seen is so at the beginning, the demand was more on the holistic approach for Paris aligned. But going forward, what we have seen is that clients are also worried about the possible tracking error that will come in the future if the companies don't decarbonize. So there's more demand on climate transition, financing the transition, but more like